Self-employed underwriters for self-employed loans look for this. You want to watch this video if you own your own business and you're wanting to know what underwriters think about when they're looking at your loan file. So the first thing to know is that you must have 2 years as a self-employed person. So just go back to when you started, whether it was your DBA or if you filed a corporation, etc. We need to have 2 years since that time. You will need to be prepared to provide 2 years of tax returns that has this self-employment income on it. Now there is an exception if you're 5+ years with the same entity, the same self-employed job. Some people have multiple companies. So 5 years with the same type of job, and you qualify for a conventional loan, you can possibly just do 1 year of return. So that's really important to know. So remember, 5+ years on that one. So let's just say 2 years, and you've got to have the 2 years. One of those years has to include at least 6 months of self-employment for that calendar year. So it needs to be at least from July to December. That's a 6-month period of time that's reflected on those tax returns, okay? The other thing that underwriters look for is we want to make sure that the income is not declining more than 30%. So we understand there's fluctuation. We understand that there's, deductions and investment into, materials and things like that. That's why we actually take the 2-year average. We know that there's, fluctuations. However, if 1 year was positive and the next year, which is the year you're buying the house, is negative, that's not a great thing. So it's really important to know, discuss that with your local lender, see if there's documentation that can be provided or an explanation, et cetera, to see if there's anything alternative that we can do. Otherwise, what we're going to do, we do verify you have the 2-year history, but we're going to take your income from the year that is the declining year. So if you had $70,000 in 1 year and the next year was $50,000, we're going to take the income of $50,000 and just divide that by 12. We're going to take the worst year in that, is what I mean. Now, what do we count as income? This is really important. I think this is one thing that a lot of self-employed people aren't sure about. We take the net income after expenses. So there's a lot of people that file Schedule C, which is the schedule on the tax return that is for sole proprietors. You don't have anything fancy like a corporation or a partnership or anything like that. It's just, most of the people are Schedule C employees, which is fine. So you have your gross, let's say your gross receipts was $200,000. And then you had materials, and you had car expenses, and you had meals, and you had office supplies, and we get it. We know that everybody's deducting as much as they can to pay as little tax as possible. We get that. However, we can only count what you claim to the government. So after all those expenses are taken, let's say in this example that the $200,000 has been diluted down after everything on the very bottom line on that Schedule C. It says net income, taxable income, as $55,000. The $55,000 is what we're going to use as the income when we take the average. Now there's a couple of things that we can add back in. Actually, I personally have been doing a lot of loans lately for a lot of truck drivers. And so there is a way we can take the mileage that they drive. So you deduct, if on the second page of that you're deducting mileage for business use, we can actually take 25 cents per mile that you've deducted, and we can add that back in to your income. So that's a cool thing. The other thing is we can add back in for depreciation. So those of you that have, equipment and materials, there might be some upswing on those numbers as well. So again, get with a local lender as soon as possible so they can look at those returns, calculate what your income is. The next thing that underwriters are looking for is we want to see your business bank statements for a couple of months, because we want to make sure that you're still making deposits. Now, during COVID, this was more necessary than not. Now, after COVID, when this video is being made, it's not as much of a big deal, but especially if your income is declining, be prepared that the underwriter might ask for, bank statements for a couple of months to just make sure that things are active. The other thing we're going to be looking at is we're going to need a letter from your tax preparer that confirming that you are in fact self-employed and that you're still active in business. Now, this is one, if you're a self-filer, we would have to have an alternate third-party disinterested party like an attorney, but it will definitely be necessary, or sometimes Secretary of State filings might be necessary. So if you're watching this and you're a self-preparer of your taxes, get with a tax preparer as soon as possible to find out exactly what might apply to you. The most important thing that we're looking for is consistency, so just keep that in mind and keep all of your records. Be prepared to give the tax returns. Be prepared to possibly write letters of explanation. If you have business returns, we also want to look at the business and see how that's performing. You might have a partnership that has a K-1 form. Be prepared to provide any addendums or any schedules for your tax return as well. So I hope that this has answered a lot of your questions and mystery around self-employed. We love to do loans for self-employed borrowers. So if you're in Texas, call me. Talk to you soon.